Now let's have a look at the objective of efficiency in terms of interpreting the accounts receivable turnover ratio. Remember, this ratio is telling us how efficient the business is in terms of collecting their accounts receivable, i.e. how long it's going to take them to be able to collect and convert those accounts receivable to cash. So when we're interpreting the accounts receivable turnover ratio, we could either be given it in terms of times per year or number of days. If we have a ratio of 10 times per year, this means that the business collects and converts its accounts receivable to cash 10 times every year. However, if it's written in days, we know that it's just simply the business collects and converts its accounts receivable to cash every 37 days. Remember, both 10 times per year and 37 days are actually going to be the same thing. Better or worse? When we're determining if efficiency has improved or deteriorated over the period of time using this ratio, it's really important to be clear on the distinction between the number of times per year it's collected and the number of days, because our analysis will change depending on which one we are using. If we're going to be talking about the collection in terms of times per year, more times collected per year is good because it means we're going to be collecting it more often. However, when we're talking about days, the lower the number of days, the better, because again, that means we're collecting it more often throughout the year. So our favourable efficiency. Let's first have a look at the number of times per year. If we're going to have good efficiency, our number of times collected per year is going to be higher than last year or higher than the industry average. However, when we're talking about days to collect, we want the days to be lower than last year and below the industry average if we want to have favourable efficiency. Equally, we need to be able to compare it to our credit terms. That's our real benchmark for success. If we're offering customers 30 days to pay, we really need to make sure that they are paying in that 30-day period to be able to be saying that we are efficient in the collection of this. However, our unfavourable efficiency. Let's again first look at the number of times per year. This means that we're going to collect it in a lower number than last year, so we're not collecting it as often. Equally, this number of times per year is going to be below the industry average. Our efficiency can also be unfavourable if our days to collect is higher than last year, or it's higher than the industry average, but probably most concerning is if our days to collect is longer than our credit period, because what that's really saying is if we're giving them 30 days to pay, but they're paying in 45 days, we're not very efficient in chasing up those payments and therefore being able to collect and convert them to cash. So improving efficiency. If we want to improve efficiency, we need to speed up this collection of accounts receivable, and it's all about the management of current assets discussed in working capital management. So the ways that we can do this is with our prompt invoicing. We really chase up our late payments quickly. We don't wait 3 weeks and then start making phone calls, sending emails and letters, etc. We do it as soon as that account becomes overdue. The next thing that we can do is we can assess the credit rating of our customers and match credit terms accordingly. Equally, we can impose interest or fees or penalties for any form of late payment. And then, of course, we can use those cash flow management strategies that we spoke about before when we're looking at factoring in discounts for early payment to actually really be able to get those accounts receivable collected more quickly. So in summary, remember, the accounts receivable turnover ratio is telling us how long it takes to collect and convert our accounts receivable to cash. It can be expressed in either days or times per year. When we're talking about the number of days, you must always round up to the next whole day. When commenting on efficiency using the accounts receivable turnover ratio, whether the result is favourable or unfavourable will really depend on if we are using times per year or the number of days. Comparisons can be used with previous results, industry average, or probably the most useful credit terms. Finally, when we're improving efficiency, we really need to go and look at that control of current assets that we spoke about in the working capital management.